Thanks so much for tuning into yet another episode of Navigating Through Uncertainty. And these are very uncertain and difficult times. But then people would say which investing period is not uncertain. However, because this seems slightly more difficult than usual, we thought let's get the best minds on the global investing landscape to try and get their sense of how they are looking at the current scenario. And in that light, a guest who I'm delighted to talk to every time I talk to him, Taimur Baig. Needs no introduction really, and combines economics and market with aplomb. He joins us on the show. Taimur, great having you. Hope all is well.
Great to be here. Thank you so much.
The pleasure is ours. Taimur, I start off with a basic question which would have an impact on economics as well as markets. I was looking at a report which said that when one looks at the past episodes of more than 300 basis points of rate hikes in the US, only in the 1993-95 period did a tightening episode not trigger a recession. My question to you is your base case of a recession in the US? And if so, what is the corresponding effect or the cascading effect on the world economy at large as a result of that?
The base case is of a sharp slowdown, not an outright recession. I'll talk about why we don't think is the case, but it's on a thin ledge. A recession is not a trivial scenario. It can happen as well. But the base case, let's say with 45% likelihood, and maybe then there's a 30% likelihood of a recession and the 20% likelihood of actually things being better. But just with a 45% likelihood scenario, so not odds on favorite, but definitely the most likely scenario in our view is one where the US economy slows quite sharply across the board. Consumption gets hit by high interest rates. Businesses stop adding to capex, but start running down inventory and actually manage low levels of inventory on expectations of weak demand. And the public sector, as we all know, right now is actually running a surplus. It's not adding to GDP, it's actually subtracting from it. So the C and the G and the I part of the investments of the economy all slow. And the net exports part of the economy start also weakening simply because of the very strong dollar. So around that, we can expect a pronounced slowdown, sequential growth rate of maybe 0, or maybe just a little more positive than that. But that too is more like a 2023 scenario, not 2022. I think there is enough sufficient momentum in the US economy, whether it is from consumption or from business spending. Things can be okay in the 2% to 3% growth trajectory for the remainder of the year. Let me give you a couple of bottom-up stories to illustrate my point. The first one is companies are not necessarily scaling back on hiring just yet. We have seen very early signs of some degree of nervousness on the employment side, but nothing that can be taken as a sign of the economy beginning to contract or heading toward a recession. Unemployment remains at exceptionally low levels. We still have companies hiring. Wage growth is substantial. And when we talk about the forward-looking part of the economy, that the doom and gloom would immediately cause companies to stop giving wage hikes or start firing people. You need to take that into the context of the fact that the company's made an exceptional amount of money the last 2 years. Despite the pandemic, we have a large chunk of the economy which had tremendous earnings, very good profitability, and therefore giving a 5, 6, 7% wage increase this year is not that big a deal. The company's employees actually expect it because they know how well the companies did. And the second is the issue of the overall consumption balance sheet, the health of consumer balance sheet. Net debt in the US on the consumer side is about 0. People have seen strong pickup in their wealth gains over the last decade. Housing has done very well. Equity market till a few months ago was doing well. More importantly, they have cut back on their debt. Credit card, housing, personal loans, in all areas, things are nowhere as dire as they were before the global financial crisis in 2008, 2009. So from a balance sheet perspective, the ability of consumers to take high interest rates or some degree of headwinds is significantly greater than it was in the lead up to the global financial crisis. So this is why we're not painting a recessionary scenario quite yet.
Okay. So if that is how the events unfold, Taimur, what's the impact on the APAC or the EM region because of that predominantly? And then we'll come to the other factors as well, of course.
Right. So unfortunately, we don't need a recession in the West to have major headwinds in our part of the world. Interest rates have gone up. They're going up much more than they have so far in the second half of the year. I think that can be said with a high degree of confidence. We probably will see 50 or 75 basis points in rate hike next month out of the US, and then follow that up with another few chunky interest rate increases in the remainder of the year. This is a big shock, and let's again put this in context. US inflation right now is running at about 8.5%. Thanks to base effect, that inflation rate will head toward 5% or perhaps even 4%, depending on how things go by the end of this year. So that's a 300 basis points of disinflation we're looking at, during which time we're talking about perhaps another 300 basis points of interest rate increase. That means real interest rate increase of 600 basis points in the span of half a year or a little more. That is an extraordinary amount of delta for the global economy to absorb. Already, we are seeing currencies under pressure in the region. We're seeing capital flows dry up. We have looked at, the equity market basically is an outflow in the last few months or so. Same with bonds. We are seeing corporate credit spreads widen. And these are all in reaction to what has happened so far. So you can only imagine what will happen in the next 6 months with respect to spreads and FX and so on, if indeed we're going to have this 600 basis points of real interest rate increase in the US vis-a-vis the rest of the world.
Yeah. That's a telling number. Now, a bit of a short-term question and then a trend question. The short-term, and I'm now bringing in equity markets also into the picture, Taimur, because you've told me in the past that you've got a strong hold on this as well aside of economics. So when you look at the APAC markets, circa 20-25% fall in whatever period that we look at, sentiment overwhelmingly negative, maybe a few green shoots here and there, but some technical indicators saying that, oh, are the markets in an oversold range? And therefore, people are evaluating if there is a sustained or a short-term bounce back imminent. What's your sense tactically?
I began my earlier question by painting a dire picture for the emerging markets. I argued that high interest rates are a harbinger for lots of bad things like widening of spreads and currency volatility. But these sort of issues cut both ways. We have to think about this from the US context, and then I'll bring it into the EM context, which is US equity markets, even after the recent sell-off, looks exceptionally highly valued. We are talking about Case-Shiller price-earnings ratio on a cyclically adjusted basis in the high 20s. These sort of PEs historically have been associated with weak forward-looking returns, meaning if today we have very high PE, over the next 10 years, I will expect fairly ordinary returns. Now, that means from a long-term perspective, the US stock market does not look like very good value. Where do we then find value? Interest rates? Well, it takes a very brave person to lock onto rates right now. We need probably a little more clarity before we start going long duration. But the next in line, in my view, is emerging market equities, because emerging market equities simply did not follow the US stock market in the massive COVID recovery that we saw in the last 2 years. You could argue India has had some buoyancy. You could argue a few other markets, but by and large, emerging markets have not done very well for the simple reason most emerging market economies have not really recovered from the pandemic. They're only beginning to experience reopening this year. They're beginning to see tourists come back, and confidence in the population among dealing with the pandemic is only forming this year, whereas in the case of the US and Europe, that's more of a 2021 story. So I think that the fact that valuation in emerging markets is far more favorable than it is in the US, the fact that the US cycle is a good 12 months ahead of the EM in terms of reopening, I think there is certainly something constructively said about emerging markets, notwithstanding the headwinds coming from interest rates and currency volatility.
So are you saying that a lot of negatives are in the price, or are you saying that there is a downtrend right now, but there could be a short-term bounce before the downtrend resumes?
It seems to me that global portfolio managers are not very forgiving of emerging markets. So the moment they see interest rates go up in the US, immediately they start selling across emerging markets. And unlike what we would like them to do, which is pick and choose between good countries or good markets and bad markets, or other strong markets and fragile markets, they sell everything. And as a result, a country like India gets lumped together with all other emerging markets, and the sell-off is substantial. But then you see the offsets coming from the domestic side. If an economy is truly fragile, not only the foreigners sell, but the domestics sell too. In the case of India, we're not seeing that, are we? We have seen the foreigners sell, but the domestic haven't really sold. So that also tells you that there is a push and a pull as far as Indian equities are concerned. Has the market priced in all the negatives? I think the market still is struggling with clarity. I don't think that you can expect the market to rally on the basis of expecting inflation to come down soon, on the basis of expecting the Fed to relent soon. I think neither of those scenarios have at all been fleshed out yet. We still have a lot of uncertainty with respect to inflation. I think inflation goes to 4% by the end of the year in the US, but I've been wrong in the past with respect to inflation. I would not be shocked if I'm wrong again. But what I'm trying to say is that from an analyst perspective, from a forecaster's perspective, from a price taker or price maker's perspective, that uncertainty will hold back confidence. And therefore, the idea that all the negatives have been priced in and therefore the market is ripe for a bounce back, I think is a rather courageous claim to make right now. As we saw in the span of the 2007-2008 crisis, there were many false dawns. The market thought that once Bear Stearns was out of the way, or once Lehman was out of the way, everything was going to get worked out. It took a good 6 months for the market to sort of come to the conclusion that the Fed put was here to stay, that no further downside risk was going to manifest. And then we saw a very powerful rally by the second half of 2008, and that led the economic recovery substantially. So again, this time will be no exception. Long before the economies turn around, the markets will rally. We're not quite there yet, notwithstanding a couple of dead cat bounce or bear market rallies that we're seeing here and there.
Okay. Yep. The small positive, Taimur, that I thought, I mean, even the conflict is raging and China is not quite opened up, and therefore supply chain snarls aren't sorted. We're seeing commodities come off quite meaningfully, and now oil too has started to come off. Now, I think a few people are penciling in that an oil price reversion is almost inevitable in a case of a recession-like scenario, if not an actual recession. So if that were to happen, which is starting to play out, and I would love to understand how you are thinking about oil, by the way, and commodities at large, do you think that's a tailwind? And primarily, actually, a prequel to this question is, what is your view on commodities and oil?
Quick answer to the last question, and then I'll go to commodities. So I think that, of course, lower energy is always a tailwind for the oil importing part of the world. And thankfully, most of the world is oil importing. And this high price of oil certainly has dented consumer expectation. So price going low will help on the margin. No question about that. It certainly does not hurt, but levels are high. So we are still talking about 100 plus oil. You could argue that nominally and in real terms, this does not mimic the oil shock of the 70s, but let's hope and pray that we don't have to deal with the 70s. This is painful. Okay, so commodity market view. I think that the Western strategy around oil initially was a bit misguided, but it's working out correctly now, which is don't get in the way of Russia selling discounted oil to India, China, and whoever wants to buy it. But at the same time, make sure that the producers in the West ramp up their production, as well as the producers in the Midwest and Middle East. And I think that is beginning to happen. And so just from a supply side, what one would like to see is cheap oil from Russia continuing to flow to wherever it goes. So Russia's earnings from the oil is not very high. The windfall is not big, somewhat lower. But at the same time, there is a strong supply response in the rest of the world, and that balances out. Before the pandemic, the US was producing 13.5 million barrels a day. After the pandemic, it went down by almost 30% to 10.5 million barrels a day. The US certainly has capacity to produce much more. There are some frictions here and there with respect to manpower, with respect to the rig supply, and also, I guess, some degree of lack of confidence on the part of oil producers in the US because they have seen very sharp swings in the bull and bear side of the market. But I think $100 plus oil month after month will have a magical effect on their willingness to go ahead and start getting the rig counts up, start hiring workers, even if it is a high cost, because it's profitable for them. That's why I think that in the near term, around the recession fear, as well as finally the correction of the strategy of the West with respect to sanctions, I think bodes well for the oil market, as in from an oil consumer's perspective, which I would like to think that most of us are. But also at the same time, just from a long-term perspective, one does want relatively high price of fossil fuel. If there's going to be a green transition, it will not happen with $30 oil, because then it doesn't make any sense to switch. So whether it is through regulation or through taxes or through whatever reason, if we only have high prices of commodities, then we will want to switch to solar and wind and so on. So in some ways, you probably want oil price not to crash, because that will undermine the green agenda.
And so if Rutger is saying that oil is the new data, and this decade could belong to oil, you reckon that we are slated for higher prices for longer, or that may not necessarily be the case?
I think this crisis has been a massive galvanizing clarion call to oil importers of the world that energy security is so paramount that one cannot be held hostage to one or two exporters. And to me, this does not necessarily mean that we're going to double up on oil exploration and oil refining. What will happen is there will be a doubling down on efforts to come up with alternative sources of energy. I've already mentioned solar and wind, but also green hydrogen, or perhaps even relooking at the issue of nuclear. I think that's where the future lies. And therefore, regardless of short-term dynamic, and by the way, one issue is there is a major shortage of refinement capacity in the world with respect to oil, and that could conspire to keep oil prices high for a while. But beyond that near-term issue, for the long term, I would not be a big bull on oil, because I do think that climate transition related activities will put a dampener on fossil fuel industry in the long term.
Okay. Last 2-3 questions. I'm bringing India now front and square in the conversation, Taimur. Some positives, if the recent correction in commodities does augur well, sustained inflows from retail, the tax collections, never mind what happened in May, the small blip, but it's still about 1.4 trillion, which is great, right? And a bunch of FTAs that India has signed with key regions in the world. What do you think about India, the economy, and then India, the market?
I think the economy has taken a number of shocks over the last 5 years, going all the way back to the demonetization and the implementation of GST and then the pandemic. And that has hurt the economy. That has perhaps scaled back the scenario in which, we were going to have, 3 trillion, 4 trillion, 5 trillion trajectory in the course of this decade. Maybe those things get slowed down. But I think these shocks have a way of strengthening an economy's backbone. That, I've taken some punches, but I've not fallen on my back. I'm still standing. And now, as the economy reopens, as tourism reopens, and as India takes advantage of the geopolitical dynamic, which is many Western companies would like to diversify their supply chain. So I think the opportunity is golden, both from a short-term and medium-term perspective. It is not an easy open goal. To build a chip fab in India would require Herculean efforts, because the sort of supply chain, the technical as well as manpower know-how that China can supply, I really don't think any country is capable of matching it right away. It will take time. It will take a lot of sweat and tears to build high-tech capabilities, which ought to be the path for the future, because the window is substantial and the gains to be had is substantial, but the work required to get that done would also be substantial.
Yeah. So in light of that, Taimur, just thinking about it, India is promoting, say, in a small way, the PLI schemes. Actually, it's not small, it's fairly large, but the PLI schemes to boost manufacturing. There is a tailwind because of China Plus One. Prime Minister Modi's tweet yesterday about Foxconn, and Foxconn saying that, oh, we might look, I don't know if a semiconductor manufacturing facility comes or no, but at least there is noise around that from their side. Does this give a boost to manufacturing, one? And are you, in your talks, because you'll be talking to everybody around the world, do you get a sense that some bit of this China Plus One hype is actually for real?
Yes. So if you were having this discussion 2-3 years ago, I would have said it's largely hype. I would have said that the supply chain of China is extremely hard to mimic. I have seen the balance shift on this issue substantially in the last 36 to 48 months. I think the drive toward efficiency took us to China. But now we're basically saying that efficiency on its own is not a panacea, that resiliency and security are important dimensions as well. This, of course, means more cost of production. This, of course, means greater friction in the supply chain. So life will not be as easy as it was 3 years ago, but I don't think politically we are ever going back to 3 years ago. And hence, this China Plus One and India being a potential beneficiary, I have shifted away from becoming fairly dismissive of that idea to seeing that as a real possibility. And to paraphrase an old American movie, you have to build it, they will come.
Last question, completely bereft of all the conversation that we've had thus far, Taimur. India's toying, or maybe there's some conversation of inflation index bonds, an attempt, the third attempt of sorts being made in India. We've never succeeded, but some of the other countries have. What's your view on this? I think
it has its place in capital market development, but as we have seen in the case of the US, it's not a panacea. It's not like the fact that the US has had TIPS type instruments for the last decade and a half has allowed the corporate sector or US consumers to hedge their exposure to inflation. What happens is when inflation is low for a long time, these products have no demand. And then when it's high, it's a lot of demand. And then in neither case, you can actually take advantage of it unless you see these things coming a long time ago. And I think this 12 months that we have seen with inflation tells us that, our understanding of the inflation process, our ability to project inflation, not that good. And we economists, as well as financial market participants, are all to blame. You look at where projections were 12 months ago, Fed projection, street projection, economist projection, nobody saw this coming, right? So therefore, nobody suggested owning tips 12 months ago either. Maybe one or two brave souls, and they're laughing their way to the bank. But by and large, I think that having these things are good from a market development perspective. They have a role to play. I don't think they will necessarily add to building RBI's credibility or bringing inflation down because people are well hedged and therefore they don't panic. I think those things work in theory. Experience from the Western market with respect to inflation index bonds suggests that there's only limited likelihood of success out of those very ambitious goals.
Taimur Baig, such a delight talking to you. And I wonder at times why we talk with such a gap. So we would love to have you more recurringly. But thank you so much for today.
Thank you so much.
The pleasure was ours, viewers. Thanks for tuning in.